Imagine an information network so accurate that it consistently beats traditional polling, legacy media, and expert analysis at predicting global events. Now imagine that network front-running a presidential election call by hours and pricing a geopolitical military operation before the White House even announces it. It sounds like the ultimate intelligence tool. But right now, a coordinated political and corporate attack is underway to classify this exact technology as illegal gambling and shut it down. My name is Lewis, and you're watching the Coin Bureau. So, are prediction markets a threat to retail investors? Are they just unregulated casinos masquerading as financial exchanges? Or are they a decentralized truth engine that threatens the establishment's control over the narrative? That's exactly what we're going to cover today. So, first things first, let's look at the regulatory war currently being waged against prediction markets. Since early 2025, platforms like Kalshi and Polymarket have exploded in popularity, generating over $44 billion in combined trading volume. By February 2026, the cumulative global nominal trading volume for the industry reached a staggering $127.5 billion. And the mainstream narrative surrounding this explosive growth is entirely focused on the dangers of unregulated gambling. If you read the headlines, you will be told that these platforms are degenerate casinos where insiders manipulate the odds to enrich themselves. You'll hear about lawmakers like Senator Jeff Merkley and Senator Amy Klobuchar introducing the End Prediction Market Corruption Act to ban federal officials from trading. You'll see reports of the Nevada Gaming Control Board filing lawsuits to block these platforms from operating. As of March 2026, well-known exchanges, including Kalshi and Polymarket, are battling nearly 50 active legal cases across the country. Regulators in states like Massachusetts, Maryland, Tennessee, and Connecticut have all fired off cease and desist letters. The official story is that state governments are simply protecting retail users from sportsbook-style betting. But if you look at the actual data and the entities funding this pushback, the real motive for the crackdown becomes painfully obvious. Because the primary institutional enemies of prediction markets are not consumer protection advocates. They are the established, licensed sports gambling companies and the casino lobby. DraftKings stock has plummeted more than 50% from its recent highs. Flutter Entertainment, the parent company of FanDuel, recently suffered its longest weekly skid in 23 years. Meanwhile, in February 2026, Kalshi's app was downloaded 4 times as much as either FanDuel or DraftKings. The Nevada Resort Association explicitly told the Ninth Circuit Court that prediction markets have increased exponentially and represents an existential threat to the state's gaming industry. So, this is not about protecting you. This is about protecting the companies that want to continue skinning you without competition from elsewhere. But to understand why these prediction platforms are taking so much market share, well, you have to understand the fundamental difference between a sportsbook and a prediction market. Here is how prediction markets actually work at the structural level. In a traditional sportsbook, you are betting against the house. The operator sets the line and breaks in a profit margin, often called the VIG, which typically sits around 10%. The bookmaker is not trying to discover the true probability of an event. They are trying to balance their book to guarantee a profit regardless of the outcome. Because of this mathematical disadvantage, users of traditional sportsbooks have a roughly 2% chance of being profitable long term, or, if you prefer, a 98% chance of losing money. Prediction markets invert this dynamic entirely. They function like financial derivatives exchanges, using a central limit order book or a CLOB. You're not betting against the house. You're trading peer-to-peer against other participants. When you buy a yes contract, another participant is selling it. The price of the contract directly reflects the collective probability of that event occurring based on market sentiment. If a contract is trading at 62 cents, the market believes there is a 62% chance of that event happening. The platform simply takes a tiny transaction fee, usually well under 1%, exactly like a stock brokerage. But the crypto angle to all of this only emerges when we look specifically at Polymarket's underlying infrastructure. Because unlike Kalshi, which is a centralized US exchange, Polymarket is built directly on public blockchain infrastructure. It runs on Polygon, a layer 2 scaling solution for Ethereum. This allows transactions to confirm in seconds for fractions of a cent, making high frequency, small positions trading economically viable for retail participants. All trading, order placement, and settlement on Polymarket is conducted using USDC, a fully reserved dollar-pegged stablecoin. In February 2026, Circle even partnered with Polymarket to integrate native USDC, further cementing its institutional-grade settlement architecture. But the most critical piece of this plumbing is how the markets actually resolve. Polymarket relies on UMA's optimistic oracle to determine the outcome of real-world events. When a market closes, an assertor posts a USDC bond to propose an outcome. If no one disputes it, the result is finalized on-chain and smart contracts automatically distribute the payouts. If there is a dispute, it goes to a decentralized token holder vote. This means that Polymarket does not hold your funds, and it does not unilaterally decide who wins. It is structurally resistant to single point of failure censorship. Every trade is recorded on the Polygon blockchain, creating an immutable, verifiable ledger of human expectations. Because participants have real financial skin in the game, these markets process information faster and more accurately than traditional pundits. They are not casinos, and instead more like decentralized truth engines. And speaking of staying ahead of the narrative before it hits the mainstream headlines, this is exactly why you need the Coin Bureau Telegram channel in your life. That is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates. All pinged directly to your device so that you don't miss a thing. Whether it's a massive shift in prediction market odds, on-chain whale movements, or regulatory crackdowns that threaten your portfolio, our members see it first. So sign up today using the link down below, or by scanning the QR code on the screen. Now, back to the regulatory war. Because while state governments and casino lobbyists publicly attack prediction markets as degenerate gambling, the highest levels of the US government are quietly relying on their data. On February 12, 2026, economists at the Federal Reserve Board published a working paper that completely shatters the mainstream narrative. The paper is titled Kalshi and the Rise of Macro Markets, and in it, the Fed's own researchers conclude that prediction markets provide a high-frequency, continuously updated benchmark that is valuable to policymakers. The data does not lie. The researchers found that Kalshi's forecasts for the Consumer Price Index provided statistically significant improvements over the Bloomberg consensus. They found that prediction markets outperformed traditional Fed funds futures in forecasting Federal Reserve rate decisions. In fact, the study noted that the Kalshi median and mode had a perfect forecast record on the day before FOMC meetings. Yes, perfect. The Federal Reserve Bank of Atlanta is already using market-implied probability trackers to estimate rate paths. And it goes far beyond monetary policy. The U.S. Army recently published an article in the Military Intelligence Professional Bulletin stating that platforms like Polymarket provide a novel type of data to identify national security threats. This is the definition of regulatory schizophrenia. The central bank and military are praising these platforms as superior forecasting tools, while state regulators try to legislate them out of existence. But to understand why the establishment is truly terrified, we have to look at the systemic threat these platforms pose to legacy media and the political polling industry. The public opinion and election polling market is a $9.18 billion industry. It relies entirely on selling curated data and narrative management. But during the 2024 US election, prediction markets exposed the deep flaws in that legacy model. While major polling aggregates described the presidential race as a 50-50 toss-up right up until the end, prediction markets consistently priced a Trump victory at roughly 60-40% throughout October. Polymarket signaled a 95% probability of a Trump victory before midnight on Election Day. This was hours before the Associated Press or any legacy news network called the race. The most glaring example was the infamous Seltzer poll in Iowa. Just days before the election, a highly respected pollster claimed Kamala Harris was leading Iowa by 3 points. The mainstream media panicked. The prediction markets completely ignored it, maintaining a massive Trump lead in the state. Trump ultimately won Iowa by 14 points. The market was right, and the $9 billion polling industry was wrong. And this accuracy extends far beyond elections. In January 2026, U.S. Special Forces captured Venezuelan President Nicolas Maduro. Hours before the White House even announced the operation, a newly created Polymarket account invested over $30,000 betting that Maduro would be ousted. By the next morning, that trader had netted over $400,000, a 1,200% return in less than 24 hours. The market priced in the geopolitical reality before the legacy media had even drafted a headline. This strips the establishment of its power to control the narrative. Anyone can look at a decentralized ledger and see the exact money-backed probability of an event. Well, the pundits lose their influence, the political consultants lose their leverage, and the legacy networks lose their viewers. More than 42 million people watched the 2024 election on TV, which does sound like a lot until you realize that it was a 25% drop from 2020. CNN saw its election night audience collapse by 46%. Why wait for a panel of talking heads to interpret delayed polling data when a decentralized market is giving you the answer in real time? The irony is that legacy media is now being forced to adapt just to survive. CNN and CNBC have both signed partnerships to integrate the live prediction market data into their broadcasts. They're adopting the very technology that is making them obsolete. But the systemic impact of trying to ban these markets in the US will be exactly what we've seen with the rest of the crypto industry: regulatory arbitrage. If state regulators successfully suffocate compliant platforms like Kalshi, the volume will not disappear. It will simply route to decentralized offshore protocols. When US and Israeli forces killed Ayatollah Ali Khamenei in late February 2026, Polymarket's offshore platform paid out $529 million on the outcome. No state-level cease and desist letter can stop a smart contract executing on Polygon. The technology is structurally immune to local jurisdictions, and we are seeing this regulatory arbitrage play out against a brutal macroeconomic backdrop for crypto infrastructure. Right now, Polygon's native token, Matic, is down 57% from its 52-week high, trading at roughly 10 cents. Ethereum is down nearly 33% year-to-date. Bitcoin has fallen 44% from its staggering $126,296 peak to hover around $70,000. And the broader economy is facing a massive downward revision, with Q4 GDP expected to collapse from 4.4% to just 1.4%. With the 10-year Treasury yielding 4.15%, the opportunity cost for retail capital is incredibly high. Yet, despite the severe bear market in the underlying infrastructure tokens, prediction market volumes, they're hitting all-time highs. Kalshi processed over $10.4 billion in volume in January 2026 alone. This divergence proves that the utility of the platform is completely decoupled from the speculative price of its blockchain that it runs on. The demand for truth is entirely independent of the crypto market cycle, and the journey of Polymarket itself is the ultimate proof of how unstoppable this technology is. In 2022, the CFTC fined Polymarket $1.4 million and forced it to block US users. In 2024, the FBI raided the apartment of Polymarket CEO Shane Copland. The government threw everything it had at the platform to shut it down. But instead of dying, Polymarket acquired a licensed derivative exchange called QCEX for $112 million. They secured a massive $2 billion investment from Intercontinental Exchange, the parent company of the New York Stock Exchange. And in December 2025, they officially relaunched in the United States as a fully regulated entity, now valued at an estimated $9 billion. The government tried to kill it, failed, and is now watching Wall Street co-opt it. And under the new administration, the federal regulatory tide is actually turning. The CFTC dropped its appeal against Kalshi, and it has actively filed amicus briefs defending prediction markets against state overreach. CFTC Chairman Michael Selig recently stated that these platforms serve legitimate economic functions and provide the public with vital information. He explicitly called the state-level lawsuits a power grab that ignores decades of precedent. So, the battle lines have been completely redrawn. It is no longer the federal government trying to secretly kill Polymarket. It is legacy institutions casino lobbyists, and state regulators fighting a desperate rear guard action against mathematical inevitability. So, to be clear, the coordinated state level attack on prediction markets has absolutely nothing to do with protecting retail investors from gambling. It has everything to do with protecting legacy institutions from accountability. When a decentralized protocol can accurately price the probability of a Federal Reserve rate cut, a geopolitical conflict, or a presidential election faster than a multi-billion-dollar news network, well, the old gatekeepers become irrelevant. The casino industry is terrified of losing its monopoly on sports wagering. The polling industry is terrified of being exposed as inaccurate and obsolete. And politicians are terrified of a public square where narratives cannot be spun because the financial reality is recorded immutably on chain. The fact that Federal Reserve economists and US military intelligence are using this data proves that the underlying technology is incredibly valuable. It is simply too dangerous to leave uncontrolled. But, as we've learned with Bitcoin, you cannot legislate mathematics out of existence. You cannot issue a cease and desist to a smart contract. The decentralized truth engine has been built. The $127 billion in trading volume proves that the demand is there. And whether the establishment likes it or not, it is not going away. But what do you think? Are prediction markets dangerous gambling, or are they the most accurate news source we have left? Let me know your thoughts in the comments down below. Now, if you want to see how the government is using tax laws to trap crypto investors, well, you could check out our video on that right over here. And if you want to understand how institutional ETF flows are impacting Bitcoin's base layer, well, you could check out that video right over here. Thank you all so much for watching, and we'll see you again very soon. This is Lewis, signing off.